Welcome to our explainer. Today we are diving deep into a huge shift in Israeli tax law. It's called the 2025 Trapped Profits Law, and if you own a business, it's about to change your world.
So let me ask you straight up. Are you a shareholder in a private Israeli company? If you just nodded yes, then you need to listen up. The entire playbook for how you handle your company's profits is being rewritten.
For years, the smart move for a ton of business owners was simple. Just let the profits pile up inside the company. Well, as of January 1st, 2025, that strategy, it's going to cost you.
Okay, before we get into all the new rules and what you need to do, let's get on the same page. What in the world are these trapped profits that this law is all about?
Think of it like this. It's all the cash that's left over in your company's bank account after you've already paid the 23% corporate tax. It's your money, technically, but it's still sitting inside the company, not in your personal pocket, as a dividend. And this is absolutely key. We're not talking about giant public corporations here. This law is aimed squarely at privately owned companies run by a small group of people, 5 or less. That's basically most of the small and medium-sized businesses in Israel.
To really get why this is such a big deal, you have to understand the old system. You'd pay your corporate tax and then nothing. You could just leave the profits in the company forever, putting off that second hit of dividend tax indefinitely. It was a no-brainer.
So that was the old way of doing things, but the government has decided that the party's over. Let's dig into what's changing. Everything really comes down to this one little number, 2%. It doesn't sound like a lot, right? But believe me, the impact is going to be massive.
And here's the kicker. This isn't a one-time tax. Nope. It's a 2% tax you'll have to pay every single year on your accumulated profits. Now, they do give you a 750,000 shekel safety cushion, but anything above that, it's like you're paying an annual fee just to keep your own money sitting in your company.
This basically forces every business owner to a fork in the road. You've got two main choices. Path 1, you do nothing and pay that 2% tax every year. Or, Path 2, you pay out a dividend to yourself and your fellow shareholders, which lets you avoid the 2% tax, but then, of course, you trigger the normal dividend tax. It's a strategic choice you now have to make.
Now, before everyone panics, it's important to know this doesn't apply to everybody. There are some major exemptions. If you run a manufacturing plant, a construction company, or you fall under certain investment laws, you might be in the clear. But for most service companies and holding companies, well, this is your new reality.
But hold on, because we're not done yet. Beyond that 2% tax, the new law has another layer to it, and this one is a potential game changer, especially if you run a service-based business.
So I'm talking to you consultants, lawyers, accountants, tech gurus, anyone who provides professional services through their company. The next part is something you absolutely cannot afford to ignore.
I know, it sounds complicated, so let's use a simple analogy. Imagine you own a really successful pizzeria with a great profit margin of 35%. The new law basically steps in and says, congrats on the great pizza, but we're splitting your profits now. The profit you make up to a 25% margin, that gets the normal, low corporate tax rate. But any profit you make above that 25% mark, we're going to tax that as if it were your personal salary.
Let's put some real numbers to this. Say your pizzeria makes 2 million shekels in turnover. The first 500,000 shekels of profit, that's your 25% margin, is taxed at the corporate rate of 23%. Fair enough. But that extra 200,000 shekels of profit you made, that gets hit with your personal tax rate, which could be as high as 50%. You can see how this radically changes the math for any profitable service business.
Okay, so you're facing these new rules, this new reality. What can you actually do about it? Well, the good news is the law isn't just about penalties. It also opens the door for some smart strategic moves. Think of it like a toolkit with a few options. First, you can reinvest those profits back into the business, buy new equipment, fund some R&D. Second, you could get creative and merge with a company that has losses to balance out your profits. Third, there's a special one-time liquidation option. We'll get to that in a sec. And finally, you could bring in more shareholders so you're no longer considered closely held.
Now, about that special liquidation, you're going to want to pay very close attention here. For the year 2025, and only 2025, the law creates a window for what's called a beneficial liquidation. This lets you move assets like real estate or investments out of the company and into your personal name for a much, much lower tax bill. This is a huge but very time-sensitive opportunity.
All right, we've covered the problem, the new taxes, and some of the strategies in your toolkit. Now let's talk about the timeline because, trust me, the clock is already ticking.
You might want to grab a pen for these dates. On January 1st, the law is officially live. That special liquidation opportunity is available for the entire year. And here is the big one. You have until November 30th to distribute a dividend if you want to completely avoid that 2% tax for all of 2025.
Now, there is a little bit of a silver lining here. The tax authority itself has gone on record saying they get it. This is a complicated change. They've signaled they're going to be a bit more forgiving in the first year while everyone gets up to speed.
But listen, a little forgiveness doesn't mean you can just ignore this. Every single company is unique. The right move for you, whether it's reinvesting, liquidating, or paying the dividend, depends entirely on your specific situation. This is not the time for guesswork. You really need to talk to tax experts, like the specialists at a firm such as Dre CPA, to figure out the best path forward for you.
So there you have it. The old, comfortable strategy of letting your profits just sit there is gone. It's over. The government is forcing your hand. Your company's profits are officially on the clock. The only question left is, what's your next move?